Hi, my name's Griffin Bridgers. Welcome to this first video and introduction to my new course and content series called A Better Guide to Estate Plan Funding. Now, before I dive into the background of this course, I want to remind you that this presentation is provided for educational purposes only and is not intended to substitute for legal or tax advice. Now, as I mentioned, this is built around estate plan funding, and as we're going to see, often that is a step in the estate planning process that is left until the very end. But my argument in this course is going to be that modern estate planning really requires us to lead off with funding, and that's not just a gimmicky different way to do things, that ultimately that's the way that things have to be done in order to be effective. Now, let's talk first about who this course is for, because this video is just an intro, but ultimately this intro is for part of a broader course that's going to be built for any wealth transfer professional who deals with estate planning and assists clients with their estate planning needs. That includes, and I'm sorry if I left you off this list, but generally financial advisors, attorneys, CPAs, trust officers, and insurance advisors. But first and foremost, what I want to tell you is that who this course is not for is anybody who is an individual or family looking for education, advice, assistance, or even DIY guidance. As I'll talk about on the next page, this course will be part of a broader offering available for subscription or purchase, but I would encourage you, if you're an individual needing assistance, one, please do not purchase or subscribe to the course. This is not intended for you, and while you can get some valuable information out of this video itself, generally these are going to be issues that are behind a paywall for a purpose. And also, please do not reach out. I am not able to assist or even respond to requests for individual advice or assistance. So that being said, as I mentioned, this video is a preview of the course to introduce what we're going to cover on a 30,000-foot view or level, but the other follow-up videos and articles and other materials will be available to paid subscribers to my newsletter, which, if you haven't already visited it, you can find it at griffinbridgers.substack.com, where I have not just this course, but a ton of various educational content, both free and paid for wealth transfer professionals. So I would encourage you to check that out, and that is where this course will live if you want to subscribe and see more. So, behind this course and why I set out to do this is that about a year ago, I had started to develop and promise a basics of estate planning course. And I had a lot of interest, especially from financial advisors, in it. And as I started to develop it, what I realized is that a lot of what I was doing is using some of the knowledge that I had taken from years of teaching estate and tax planning to advisors seeking their CFP designation. But a lot of those materials used a comprehensive traditional approach to estate planning that, for reasons we're going to talk about, is no longer as relevant or actionable in today's modern estate planning environment. And as I went along, I also received several requests from financial advisors especially, but occasionally from attorneys too, on more complete estate planning guidance than they were receiving from other thought leaders out there. And as I started to look at the tenor of the types of questions I was receiving and the types of issues that both advisors and attorneys alike were encountering, I realized that a lot of them were ancillary to what we're going to come to find out is the funding of the estate plan. So that's why I pivoted to provide this course, because this is really going to be what was my promised basics of estate planning, but what we're going to end up doing is turning on its head the traditional approach to estate planning, which often leaves funding till the last step, but as I'll argue and as I mentioned, is really the step we should lead off with. Now, what this course will not focus on, and what is usually the backbone of a lot of courses in this vein, is a focus on documents. And yes, documents are important, and often documents drive funding, but I think it's better to focus on funding first, especially given some of the principles we're going to discuss here. So, really what we're going to focus on are things like asset titling, beneficiary designations, and other forms of state law rights, which, as we're going to find out, actually all override the documents in a variety of situations. Now, there's one issue that is going to be left untouched by this course, and that's going to be the issue of varying state laws and varying policies and procedures of various financial institutions and asset custodians. I cannot cover the laws in all 50 states, but I can try to draw an average or common law that has principles that are generally applicable that might have small changes state by state. So ultimately, you will have a little bit of homework because this won't be complete in terms of what your state provides potentially. So it'll be on you to go see, one, what your specific state says, and two, especially if you're a financial advisor, what your asset custodian has in terms of policies and procedures and designations to dictate who the beneficiary might be or who the owners or how the titling of an account might go. All of those can vary as well. So all of those are items that I can't necessarily cover comprehensively. You will need to do your homework and heavy lifting. So the problem with what we are going to call traditional estate planning is that it's built around the presence or absence of a will, which I alluded to on the last slide, can be potentially overridden by certain types of asset titling. So traditionally, we didn't have to do much more than create a will, because if you had a will, your property would be distributed according to its terms. And when I say property, what I mean is all your property. And even if you lacked a will, or if your will had holes in it and that it was invalid or did not dispose of all of your property, then you had a second net to catch everything called the intestacy laws. Now, as long as you had a will with a residuary clause, it would be that first comprehensive net to catch all of your property. And even if you didn't have that effective net to catch all of your property, the intestacy laws typically would, as long as you had living heirs or takers who could be identified. So what this meant is that under traditional estate planning, a will applied to your entire balance sheet. We did not have to individually plan for and list out and name every single asset as part of the estate planning process or in the will itself. Instead, I'm going to call them shortcuts, but they weren't necessarily that. There were certain legal terms where, one, we could classify property according to its state law classification, like real estate or tangible personal property or intangible personal property. And we could also use class definitions to put together individuals or groups like descendants or a spouse or extended family. And with these commonly accepted legal definitions, we could catch everything without having to list out everything unless you intended to give away specific items or specific dollar amounts. So because of that, we had this traditional backstop approach we could rely on where we didn't have to be concerned with asset titling or asset level decisions. Now, there was a problem with the traditional approach which kind of led to the environment we find ourselves in now. And that problem was that property passing, whether under a will or subject to intestacy laws, is subject to a process called probate. Now, probate is often demonized. There are some benefits to that process that we'll discuss later in this course. But in most states, with varying degrees depending on the state, there were some negative outcomes that were often cited as reasons to try to avoid probate. One being that it's a public process. Anybody who wants to can go to the courthouse and get access to probate filings and possibly even a copy of the will to know who is receiving your estate. Another issue is that probate can cost a lot. You have to pay attorneys, you may have to pay executors fees or commissions, you may have to pay other professionals like CPAs and valuation experts. Now, with those latter ones, you may still have to pay them even without probate, but the long story short is you had a lot of professionals and a lot of fees being paid out of the estate, netting out from what the heirs might ultimately receive when the estate was settled. And then, perhaps worst of all, it takes a long time, which can be a huge deal if, for example, we have a breadwinner who dies and dependents are waiting to be paid out during a long period of maybe 6 months or a year or more where there's no income coming in. And there's state laws that help get around that, like the family allowance, but they may not be complete, especially given the current economic environment. So modern estate planning and modern laws shifted to a focus around avoiding probate. But in the process, ironically, they made things a bit more complicated. In effect, what we're going to find out is that they created an environment where we have to pre-probate the estate on an asset-by-asset basis. So with traditional estate planning, we were only operating from one bucket, which had what we're going to call probate assets. Now, you don't need to know what these assets are specifically. We will cover them in a later installment of this course, but this is a quick overview. But given the increased emphasis on avoiding probate, where did things shake out? We ended up with an environment where there are now actually several assets that are not affected by the terms of somebody's will. And they may not be affected by terms of revocable living trusts if those are made. And we're going to table that discussion for now, as it will be covered in multiple later installments of this course. But I want to remind you that revocable living trusts often come with a pour-over will. So no matter what, you have a will or intestacy, but only applying to probate assets. But we're going to find out is that these other assets that overrode the terms of the will or intestacy, we're going to call non-probate assets. These are assets that would bypass the probate process. They included things like assets that had an individual or trust as the named beneficiary, including under a POD or TOD designation, which has increased in popularity. We'll talk about those in greater detail in this course as well. This can also include jointly titled assets, whether between spouses or non-spouses, where there are rights of survivorship attached. If you're in a community property state, or if you've left a community property state, this could also include at least 1/2 of the value of community property. While less popular, but also a traditional planning approach, you may have assets that by title were split into life or term interests with remainder interests that were vested under a deed. And then finally, assets that are held in trust at the time of the death of the individual creator of that trust would also avoid probate. So all of these were non-probate assets, but other assets that are individually owned, including those in this list that name the estate as beneficiary, are still subject to probate and thus are subject to the terms of the will or intestacy laws. But ultimately what this meant is that most individuals have two parallel but unrelated estate plans. Non-probate assets, which we always start with first since they override the terms of the documents, and then probate assets as a second traditional bucket that we used to operate from when doing will-based type of planning. Now, the planning principles for each of these buckets are different from each other. What you do with one bucket doesn't affect the other, or vice versa, unless we engage in specific intentional planning to merge the two buckets. And ultimately, that will be the goal of this course, and that will be what we come to find out is our new definition of estate plan funding. So we can see here the parallel estate plans listed out with the relevant assets in each. And if we're reading left to right, we always start first with the non-probate assets having priority because they override any documents that would usually just traditionally affect probate assets. So when we look at the broader planning for the non-probate bucket, it differs because planning for the probate bucket let us just create one will to capture all assets in that bucket. However, non-probate bucket planning requires us to take an asset-by-asset approach, which can take a long time. And not only does our initial planning require us to take an asset-by-asset approach for that non-probate bucket, but if we want to make changes to that plan, then we may have to again take an asset-by-asset approach looking at that non-probate bucket. That can be very complicated and unwieldy, and it increases the risk of, one, mistakes in the plan that will affect whether the client's wishes are carried out, and in the worst case, it can lead to costly litigation and hurt feelings, which ironically then undoes all of the benefits we thought we were gaining by avoiding probate to begin with. So ultimately, the great secret, and this is a lot more impactful for clients when you illustrate things this way than you would think at first glance, because this is something a lot of us in the planning community subconsciously know, but rarely consciously convey or recognize. But that is that a client's will, or the intestacy statutes, only affect one of these buckets. And if you ask the client to guess which one, then you can tell them, okay, if you guess the probate bucket, you are correct. But probate bucket is last in priority. So what we have to emphasize is that all assets in the non-probate bucket are going to bypass the terms of documents. So you can spend thousands of dollars on a comprehensive set of estate planning documents, but even after that, you may just have an expensive pile of paper if you haven't engaged in the proper planning for non-probate assets. The only difference here is that if you have assets that name the estate as beneficiary, that can shift them from the non-probate bucket to the probate bucket. And that itself might be a bad outcome for reasons we will discuss throughout this course. So ultimately, what we end up with are two parallel estate plans that operate from different principles. And a lot of the principles we're used to only apply to the lower priority red bucket in terms of the order of how things apply in the property distribution waterfall upon someone's passing. So, as I mentioned, changes to the probate bucket simply require the creation of a will or a codicil to the will, and that change or creation of a document universally applies to all of the assets in that probate bucket, whereas on the non-probate side, changes to each specific asset have to be made, which, as I mentioned, can be very time-consuming. So, it makes sense when we consider this that perhaps we should be leading off with planning around at least the non-probate bucket. So how can we effectively plan for both of those? We don't necessarily want to emphasize one over the other, but the natural order of things says that because non-probate assets override the will that affects the probate bucket, we really have to lead off with planning for non-probate assets. So really what this course is going to focus on is specific estate planning for each relevant bucket, but with an emphasis on the specific assets and strategies that we find within the non-probate bucket. And we're going to look at how we integrate the two buckets so that we can make changes to an estate plan that affect all assets in both buckets, which is what we're going to come to find out is called funding. No matter what, we're not going to avoid the upfront need to plan things on an asset-by-asset basis. And as we're going to find out, regardless of whether we're in the probate or non-probate bucket, administering somebody's estate is also itself going to require us to administer on an asset-by-asset basis. But we can at least streamline during life the estate planning process to find ways to integrate the two buckets so that our wishes between the two are common. Now, funding can be a loaded term, and it's sometimes weaponized between advisors and attorneys to reflect the shortcomings we feel the other has in the estate planning process. But ultimately, there's one broad goal: making sure assets in the non-probate estate plan do not unintentionally bypass the written terms of estate planning documents. So ultimately, we're going to talk more about how we get here in subsequent course installments. But for the time being, I want to leave you with a few key takeaways if you remember nothing else. Traditional estate planning centered on the probate bucket, and it did not require funding. Instead, we could just simply do one will or even rely on the intestacy statutes, which would catch all assets in that bucket. And funding is a fairly new concept. We didn't always have a non-probate bucket, at least not as dominantly as we have now. In modern situations, it's often the case that the bulk of a client's net worth might be found in the non-probate bucket, which again means that we need to emphasize that bucket out of the gate. And the funding principles within the non-probate bucket are not uniform across all assets or all types of dispositions for reasons we're going to later discuss. Now, worst of all, wills do not apply to the non-probate bucket unless the beneficiary designation names the estate, which is a bad outcome we're going to want to avoid in a lot of situations. And what's worse, planning for the non-probate bucket requires an asset-by-asset analysis. But based on the principles of this course, we're going to learn how we could possibly just do this once and not have to again go through this asset-by-asset analysis if we want to make changes to the estate plan down the road. So ultimately, funding, if you remember nothing else, will have as its central goal to make sure that we only go through this asset-by-asset analysis once when the plan is created and not when it is changed. So if you're interested in this course, like I said, you can subscribe to my newsletter at griffinbridgers.substack.com, and I want to remind you, only subscribe if you're a professional advisor who's interested in this course and who assists with estate planning issues. So what I plan to do is have a frequency of one installment every 1 to 2 weeks, depending on my schedule, because remember, I work a full-time job in addition to this newsletter, so I can't always be on top of things as a one-man show. But if you don't want to wait for the installments and you'd rather get everything in one info dump, then at the end I will make the course available for purchase in its entirety. But that may be a few months down the road, so if you want to get the info as it comes out, I would encourage you to subscribe. Now before we go, I just want to give you kind of a lay of the land that a lot of attorneys and especially financial advisors feel like they have to add estate planning, but they're often given incomplete marketing or advice, often from a new wave of software providers or practice support groups. So ultimately, the big question I have for you is whether you actually want to provide estate planning. And if you do, then this course is a good start, but I'll have a lot more content coming down the pike, especially in terms of what estate planning means after the great wealth transfer, in terms of the generational transfer of wealth that is starting now and is going to continue over the next couple of decades. And I'll also have more content on addressing a human side of planning. However, for now, we're not focused on the human side, we're focused on the logical and technical side. And my goal here is to provide you a better set of tools than you may have been provided in your other educational content. But ultimately, my job at the end of the day is educating you. I'm not here to sell my services other than a subscription to my newsletter, but I'm happy to be a resource for you if you do not want to walk alone. So that is perhaps the role that I play, is not necessarily mentor, but being that partner who can help you with these issues as you encounter them. But that being said, thank you for your time in listening to this video, and if you're interested, I look forward to seeing you in the future installments of